short selling is it's an interesting item to study because it's ruined a lot of people.
All right, hello fellow intelligent investors. My name is René Sellmann. And as the clip at the beginning of this video already indicated, today I want to talk about short selling. I will explain how short selling works, I will show you what Buffett thinks of short selling, and lastly I will outline some more nuanced points that I think every investor should be aware of. So let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Sellmann, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Okay, before we listen to Warren Buffett again, let me just briefly outline how short selling works. Essentially, the short seller borrows shares from his broker, sells the shares on the open market, and then assumes or hopes that he or she will be able to buy them back at a lower price in the future. And if this works out, his profit will be the difference between the selling price and the purchasing price. And maybe we should illustrate this with an example. Let's consider Daniel. Daniel believes company X is overvalued, and so he wants to short the stock. And for that reason, he goes to his broker and borrows 10 shares of company X. He then immediately sells these 10 shares. At that point, the stock is trading at $20 per share. So he pockets $200. Now fast forward 3 months. Let's assume that just recently the company was reporting poor earnings and the CEO of the company resigned because he saw a limited future for the company. As a consequence, the share price plummets and drops 50%. Now Daniel becomes a buyer of the stock again and buys back the 10 shares he had previously sold. But as the share price went down 50%, he only has to pay $10 per share now, and thus $100 in total. He obviously needs to return the shares to his broker now, because when you borrow something, you will have to give it back. But nonetheless, he can pocket a profit of $100, and that's a return of 50%. I know that a lot of people find short selling confusing, mainly because of the fact that no out-of-pocket money is spent on the stock at the onset of the trade. But I hope this illustration helped you to understand what the short selling process looks like. Put in a nutshell, this is how short selling transactions work and how investors in theory can profit from this strategy. However, Warren Buffett, the best investor of all time, he does not short, and he tends to stay away from short selling, as according to him, the short selling experience can be very painful. Well, at least he no longer shorts. In his early years during his partnership days, Buffett actually made use of some short selling as a hedging strategy for his long positions. But as I said, this was during his partnership days a long time ago. So let's once again listen to Buffett and let him explain why short selling can be so dangerous. The example of Daniel, it sounds great in theory, but obviously in practice short selling is often not quite as easy. And here's what Buffett said during the 2001 Berkshire Hathaway shareholder meeting.
It is the sort of thing that you can go broke doing. Bob Wilson, there's famous stories about him and Resorts International. He didn't go broke doing. In fact, he's done very well subsequently. But being short something where your loss is unlimited is quite different than being long something that you've already paid for. And it's tempting.
So let us pause the clip here right away. Essentially, what Buffett points out is that shorting by its very nature provides limited upside, but potentially unlimited downside, because theoretically a stock can rise to infinity. And that's why you can go broke if you don't know what you are doing. If we consider the example of Daniel again, what's the best case scenario for him? Well, if the company goes bankrupt and the stock goes to zero, he's up 100%. But that's the maximum return he can get. And basically that's why his maximum return is kept at 100%. Now what's the worst case scenario? Well, if you follow the investment news just a little bit, you will have noticed what happened to the stock of GameStop, Within a matter of days, the stock pretty much went up from around $20 per share to over $300 per share. Let's consider Daniel's stock again. He bought it for $20 per share, right? So let's assume the price did not go down to $10 per share, but actually went up. Let's say it went up 10x. Then Daniel would have to buy back the 10 shares he borrowed. Well, he'd have to pay $2,000 to be able to return the shares to his broker and close his short position. That's a loss of 1,000%. So clearly, when a short position goes against you, again, just look at the stock of GameStop. There's no limit to how much money you can lose. And this is truly scary stuff if you ask me. Now, we just said that in one of these scenarios, Daniel's return was 50%. On a best case scenario, it could actually be 100%. That's the maximum return. But in one of the more scary scenarios, it was a loss of 1,000%. Well, I know that a lot of people struggle with the idea of how to calculate the return on any short sale. That's why I wanted to show you the following table that I found on Investopedia that kind of clarifies how different returns are calculated based on the change in the stock price and the amount owed to cover the liability. Now, in contrast to a short seller, an investor that buys a long position, well, he has an unlimited upside gain potential and the downside risk is limited to a loss of 100%. Hence, one can say that for short selling, the risk and reward skew is actually reversed. And this is what Buffett is referring to in this clip that I just showed you. Now, in fact, short selling can get a little more complex. There are initial margin requirements and maintenance margin requirements, but I don't want to get into these concepts in this video. But maybe just briefly speaking, the broker that borrows a short seller shares of a stock, well, he needs to ensure that the borrowed shares can actually be bought back in the future and returned to the broker. A so-called margin call is the alert sent to an investor or trader that notifies him or her that the capital in the account has fallen below the minimum amount needed to keep the position open. A margin call can mean that the investor now has to add additional funds to the account or close the position to reduce the maintenance margin requirements. All of this can lead to a short squeeze where a sharp increase in the share price forces investors who had bet that the stock would actually fall to buy back the stock in order to avoid even greater losses. And if a lot of short sellers simultaneously are forced to buy back the shares, then the situation can quickly get out of control and you get a short squeeze. Of course, the price increase might only be temporary, and the short seller could know that the current market capitalization of the company is outright ridiculous. But only very few short sellers can actually afford the risk of infinite losses. So clearly one of the risks of shorting or selling a short position is the risk of running out of money when basically you are shorting a stock that becomes extremely overvalued. An overvalued stock could actually continue to go up much higher even though there is no fundamentals supporting that story or that share price increase. Again, you just need to take a look at the stock chart of GameStop, or another famous example would be the short squeeze of Volkswagen in 2008. In fact, the short squeeze temporarily made Volkswagen the most valuable company in the world. So if you ever need a reminder why you should not short stocks, just look at these two charts. As I said, I don't want to get into more detail here. What I do want to take a closer look at though is the fact that many investors find it tempting to short stocks. And that's because, generally speaking, it's much easier to find wildly overvalued stocks than it is to find significantly undervalued stocks. In a way, one could say that Mr. Market, the one offering you the shares at a specific price each day, well, he tends to get much more euphoric than he does get depressed. And here's how Buffett explained this point during the shareholder meeting at Berkshire.
It's tempting. You see way more stocks that are dramatically overvalued in your career than you will see stocks that are dramatically undervalued. I mean, it's the nature of securities markets to occasionally promote various things to the sky so that securities will frequently sell for 5 or 10 times what they're worth, and they will very, very seldom sell for 20% or 10% of what they're worth. So therefore, you see these much greater discrepancies between price and value and on the overvaluation side. So you might think it's easier to make money on short selling. And all I can say is it hasn't been for me. I don't think it's been for Charlie. It is a very, very tough business because of the fact that you face unlimited losses and because of the fact that people that have overvalued stocks, very overvalued stocks, are frequently on some scale between promoter and crook. And that's why
there's one more aspect I would like to add here actually, and that is that a short seller is essentially trying to time the market. Thinking that a stock is overvalued is one thing, but actually putting your money down and betting that the stock will go down sometime in the near future is something different. Shorting in a lot of ways is speculation, I think, because you cannot know when or if ever a stock is going to go down. Even though you might be right that the stock is worth less than it is trading for at the moment, you can still go broke or lose a significant amount of money. In fact, there are a lot of well-known value investors that have tried to short Tesla and basically got burned. As Keynes said in the 1930s, markets can stay irrational much longer than you can stay solvent. And other investors have added that one should never try to short a cult stock. Sure, some people make money by shorting certain stocks, but just because some people make money with a specific strategy doesn't necessarily mean that you or I have to use this strategy as well. I think there are easier ways to benefit from the stock market that are also less risky, so why should I bother? One of the key mental models of legendary investor Charlie Munger is to start with the don'ts. So I may just actually show you my investment framework. And in this framework, I have a specific section devoted to the don'ts. I firmly believe that just like amateur players would get better results if they would focus on avoiding mistakes instead of trying to hit Federer-like winners or lobs, investors would also achieve a better performance if they would place more emphasis on the don'ts. As Tom Watson, founder of IBM, once said, "I'm no genius. I'm smart in spots and I stay around these spots." So that's why I very clearly define what I don't want to do, and I rigorously stick to this. One of the don'ts, obviously, is that I don't want to short stocks. So my tip for you here is to do something similar. Develop a clear process and then stick to it for a long period of time. And if you do this and the principles in your process are sound, then you will inevitably have success in the stock markets. And with that being said, may your finances and investments prosper. Good luck.